The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Welcome to the Accunet Mortgage and Realty Show, getting you inside information on buying, selling, and financing your home with expert advice from Accunet Mortgage and Realty's Brian Wickert on WTMJ.
Well, good morning. It's good to be back here after a 3-week Packer-induced hiatus. I'm Brian Wickert, majority owner and president of Accunet Mortgage and also licensed real estate broker at Accunet Realty Advisors. Joined this morning by Jerry Sirkatich, one of our other 3 managing owners and senior vice president and senior loan consultant, even though he is nowhere close to being a senior citizen. I got that.
Thank you for that.
That's right. If you have a comment or a question, you can get a hold of us by phone or text on the Accunet Mortgage Talk and Text line, 414-799-1620. So, Jerry, a lot's happened in the last 3 weeks. We were talking before we lit this candle and started the show. Probably the most newsworthy thing relative to financial markets and interest rates is the Fed cutting rates. So does that mean that all interest rates have gone down, Jerry?
No, it does not, Brian. And You're right. That is something we should touch on because it's very topical. And most of our consumers, home buyers, those that are thinking about refinancing, saw that announcement and immediately thought, what?
Hey, can I drop my rate 0.25%? Because that's the Fed cut 2 interest rates. The Fed only has the capability to cut 2 rates. The discount rate, which I had to look up the definition of, that's the interest rate that the Fed charges banks if a bank wants to borrow directly from the Fed. And that's at 2.5. And then they also regulate the interest rate that banks charge each other overnight.
Right.
So we're not even talking 24 hours.
Right, very short term.
Right. It's not even 12 hours. I mean, well, maybe 12. All right. And that dropped down to a range of between 1.75 and 2%. Second cut in as many months for those short-term rates. But what consumer rate, Jerome, does get impacted immediately by those Federal Reserve moves?
The one that is most notable is the prime rate.
Oh, the prime rate. And that is used for?
Home equity lines of credit, which is what most, the folks that we're talking about are most impacted by.
Yep. And then what else?
Well, credit cards, auto loans, many of the consumer-type loans.
Okay.
But not mortgage rates.
Not the 30-year fixed rate. Because you see, folks, overnight is the way short end of the spectrum, and 30 years, which is 3 decades, is pretty far on the other end. Okay. Now, in fact, though, the 30-year fixed rate is up a little bit since the Fed cut, which is totally counterintuitive.
Correct.
Probably the best article I read was right around when they dipped to their nadir, which is the low point.
Okay.
Yep. New vocab word for you there.
Right. Word of the day.
Word of the day. And it was from the J.P. Morgan Chase head of domestic bond hedging. I mean, so this guy drinks, sleeps, and breathes interest rates on U.S. items all day. And he was saying, you know what? I kind of think that interest rates are about 0.25 point too low. And the reason was, he said, computerized trading. Everybody's computer model in August, when stock portfolio managers and money managers were all clutching their chest over what? The trade.
Well, the trade war. Yeah.
The trade war.
Yeah.
Right. And so stocks were sliding down, and everybody was like selling stocks and buying, in particular, U.S. Treasury bonds, which are sympathetic. They are not directly tied. I always chuckle when I read the Wall Street Journal says, oh, the 10-year Treasury yield, which is the benchmark used to set mortgage rates for 30-year fixed. No. They are not directly tied. They are sympathetic, and they move in the same direction, typically, but not in exact harmony.
Right.
And so anyway, that yield on the 10-year Treasury, which is kind of easier to talk about, that thing reached a low point of 1.43 on about September 5th. Shot up then to as high as 1.9. So a 0.5% increase since we had our last show, and now has since settled down to about 1.69 at the end of the day this week. All right,
pretty close to what this this article had reported.
The Chase
trader who is in the know.
All right, so here's a quick thing of what this means. So if you're carrying a $50,000 balance on your home equity line of credit, and your rate just went from 5.25, that was the old prime rate, down to 5%, you're going to save $10 a month. on your interest. The interest expense is going to go from 218 down to 208. Credit card rates also tied to the prime rate. What do you think? I looked this up, and I didn't ask you this beforehand. What do you think the average credit card rate is if you've got excellent credit in America?
Excellent credit, 12 to 14%.
Boom. Wow. Jerry the savant. 13.6, that's according to Wallet Hub's credit card landscape report. Now, if you convert that 50 grand that you're carrying on your home equity line at 5%, let's say not everybody gets to borrow at 5.
Right
Right at the prime rate.
True. Depends on your equity level, depends on your credit profile.
Yep. So you might be
forth.
at 5.5, 6, who knows?
Right.
But let's just say 5. And you converted that over to a 3.99 30-year fixed, which is what we could offer with no points if you're taking cash out to consolidate.
Mm-hmm.
So this is the idea of refinancing your first mortgage and using it to consolidate the balance on your home equity line. Your payment would go up $30 a month, but that's because you're starting to pay principal. In fact, you're starting to pay $72 of principal a month by converting it from that interest only, meaning it never goes away, to the amortizing.
And might add variable rate.
Correct.
Home equity.
That's right. That's right. So now I did one other quick one before we take this break. What if you had a $100,000 first mortgage at a rate of 3.5? So you're thinking, I don't want to give that up. You got $50,000 on a home equity line at 5.5, and let's say you got another $8,000 on a credit card at 13.6. A lot of people are paralyzed because they don't want to give up the 3.5
right
on the first mortgage. When we come back from this break, I will reveal whether or not it was a good idea for this person to pull the trigger and consolidate it all. You're listening to the Accunet Mortgage and Realty Show on AM 620 WTMJ.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on WTMJ.
All right, we are back, and I'm here with Jerry Circutich this morning, our Senior Vice President, Senior Loan Consultant, all-around great guy, sometimes host of the Accunet Mortgage and Realty Show.
Yes.
Former real estate broker yourself.
Indeed. Yeah.
That's right.
And it's great to be back here with you.
Yeah, good. All right, so right before the break, we were talking about how, hey, interest rates are still good, not quite as low as they were at the beginning of this month, at the beginning of September, but still plenty good enough to help people do what financial professionals call a balance sheet restructuring. In other words, take a look at all your debt. And so the example that I threw out there is you got $100,000 on your first mortgage at a trophy rate of 3.5. You got a home equity line balance at $50,000 at 5.5, 1/2 over prime. And let's say you're carrying $8,000 on a credit card at the average national rate of 13.6. People don't walk around with their calculators out, but we do. Jerry doesn't have it on his hip. But the weighted average rate on that. In other words, you take how big is the balance in relation to the interest rate. That person is paying 4.64% as the weighted average rate. So if we can consolidate all that together on a 30-year fixed rate at 3.99, why wouldn't you? Plus, you're going to start to chip away at maybe some of those balances that you weren't really chipping away on.
Correct. Before. Like the home equity line, I think you pointed out, it's an interest-only payment.
That's right. Yeah.
So you're not doing anything to reduce principal, and yeah, that's a powerful. And the other point I will make, or when I'm talking to someone, is confirm that they're not viewing that other debt as short-term debt.
Right.
In other words,
you don't have a plan to pay that off next week.
Right. If they have a plan to pay it off in 12 months or very short time frame, they may be better to stay the course. But that's not the case, like with this example and with many.
That's right. So we're gonna try to help you make a smart financial decision. All right. So then you were saying you were looking at our show from a year ago.
Yes. This was interesting. I think most will find it interesting. A year ago, this was early October. There was a Wall Street Journal article: mortgage rates fast approaching 5%. A fresh blow to the housing market.
A fresh blow.
Yes. In the lead paragraph, it indicated that rates were at their highest level in more than 7 years at nearly 5%. The Freddie Mac weekly surveyed rate, which we reference quite often, is 4.9% in early October, 3.64% this past Thursday.
Okay, if you're willing to pay 0.6 of a point.
0.6 of a point, exactly. That comes
never reported.
Yeah, correct. But yeah, that is the headline.
So we're over 1% lower, and that was not predicted. In fact, the prediction going into the end of last year was that rates were going to be around 5% all this year and trending higher. Correct. Here we are now in the mid to high threes, which is fantastic. Just by the way, I pulled up the newest Fannie Mae forecast for 2020.
Okay.
I mean, you haven't seen it because I've got it on my separate screen here. What do you think they're predicting for the third year? It happens to be the same number for the entire year 2020.
4.25%.
3.4.
Wow.
From their lips to God's ears is what we like to say.
All right.
That. Now, remember, these are the same economists that said it was going to be at 5. And
in
now
2019.
Yeah,
this
right.
year.
So, like weather forecasters, not always the most accurate. I was mentioning to you before we started the show today that I had a past customer call up and has a little over $500,000 balance at a fixed rate of 30 years at 3.875. Lucky enough that he makes a lot of money. He's got a big bonus, and he's like, Brian, I'm thinking about paying it off. Or maybe I should pay it down, or, what should I do?
Mm-hmm.
And so I crunched some of the numbers, and I ended up coaching him that why don't you let us take, instead of paying it all at once off, right? This is called highest and best use of your cash. I said, why don't we go to a 15-year fixed at 3.5, and then you're going to pay it off aggressively, but you're going to kind of dollar cost average your way out of the debt, which allows him to do what?
Well, to invest.
Yeah.
I mean, because 3.5%
fixed cost.
Fixed rate
right.
is inexpensive money.
That's right. Plus, on a 15-year fixed, 60% of your first monthly payment is going towards, or maybe it's 58. It's over half.
Oh, wow.
It's going towards principal.
Correct.
So you're really minimizing your interest expense as well. So, a lot of people think, if you listen to Dave Spano on Annex Wealth Management, you dollar cost average into the market. I'm going to invest $1,000 every month.
Right.
You're going to dollar cost average your way out of this cheap debt and allow that $500,000 to work for you in the market. All right, when we come back, we're going to talk a little bit about the state of the housing market here in southeastern Wisconsin. You are listening to the Accunet Mortgage and Realty Show on AM 620 WTMJ.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Weckert on WTMJ.
And this morning, Jerry Serkatich joins me on the show. And so let's talk a little bit about the current state of the housing market in southeastern Wisconsin, because if you read some of the national stories, it'll tell you that, it's flipped to a buyer's market, meaning there is more supply and not as much demand, maybe if you're talking in California or who knows where else.
Right, the coast.
Yeah, all real estate is local.
Mm-hmm.
And so you were quoting that same article talking about the 4.99 rate last year, a year ago. And what did they say about the housing market?
It indicated that 5%, nearly 5% interest rate level could determine many home buyers, in terms of their
proclivity desire
to buy, and represented another setback for the then slumping housing market, as the Wall Street Journal called it a year ago.
Well, all right. So even when you're talking about southeastern Wisconsin, it's not all one market, both geographically and price-wise. So I was talking with Paula Langlois yesterday, or on Friday, I guess that's 2 days ago. She is one of Shore West's top agents, if not the top agent. She has many years been the top agent in Brookfield and Waukesha. And she was recounting that she was involved in a transaction recently, earlier in September. Home was priced in the 400s and had 6 competing offers.
Wow.
Yeah. And that's what we've seen all spring, all summer.
So much for a buyer's market.
So much, not a buyer's market. And I mentioned, I think before we took our last break, I've got a client who is relocating from Neenah, Wisconsin, and is going to be looking in Waukesha. And so he was surprised and shocked when I said, now, are you going to try to write an offer on a Waukesha County home before you sell, or are you going to have to, before you sell your Neenah property? In other words, are you going to write a contingent offer? I will buy your home in Waukesha as soon as I sell my home in Neenah. He said, well, yeah. So you aren't going to get any accepted offers, not in the $200,000 to $250,000 price range that you're looking in, because somebody else is going to have an offer that's not contingent. And then it's easy to say, now just think about that. When you're selling your home in Neenah, you've got 2 offers. One that says, I'll buy it as soon as I sell my house. And another one says, I'll buy it right now. That's an easy decision.
Right, something you mention a lot, or I do, to someone like this. You put yourself in the shoes of the seller. You know what? Because you will be a seller very soon.
That's
and,
right.
And presented with those, in your example here, 6 competing offers.
Yeah.
It's likely at least one is going to be non-contingent.
Yeah. If not 5.
Right.
Yeah, you're going to be the only guy contingent. So we talked about possibly doing a bridge loan, or I ran the numbers actually this morning, and he could afford to buy a $190,000 home if he doesn't sell his home in Neenah first. But then if he does sell in Neenah first, or we are, then he could buy like a $300,000 home. So another thing that was an eye-opener for him is I said, maybe you come down here since you're new to the area and rent for 6 months. He goes like, really? You could rent for 6 months somewhere? I'm like, yeah, I think you could. Or maybe, I didn't say this to him yet, I will when I talk to him again on Monday. Maybe you go and stay in a Homewood Suites, just pack up your stuff from your home, because you're like, I really don't want to move twice. And I'm thinking, okay, you're a single guy, you're 57 years old like me. How much stuff do you have?
Probably too much.
Probably too much.
Yeah.
But at least, get the moving company to store it for a month or two. And then, you're not quite as under the gun, and you'll be in a much better position. Plus, maybe you'll get to look around a little bit.
Yeah, and many leasing companies, I believe, offer
a 6 month,
well, even a monthly,
really?
a 3 month, a monthly,
Okay.
certainly 6 month. They may charge a bit of a premium to the rent, but in a case like this, it may be worth paying a slightly higher premium for that monthly rent to have that flexibility.
So, let's we're coming up here on the news break, and let's talk about his situation a little bit more, because I think it is instructive as a 57-year-old single guy. He was thinking, I'm going to roll all my equity over, and then I want a 15-year fixed on my new house because I want to get this debt paid off. Again, we had an interesting conversation. We'll tell you about that when we come back.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on WTMJ.
I think we used to do this song. I don't know what it is.
Is that right?
Maybe our producer can tell us what it is, but I love this song back in the day. Anyway, so we're talking about the relocating home shopper, a seller up in the Fox Valley, and then coming down here to hopefully buy in Waukesha County. So I shot him some numbers this morning. And I showed him, this is another interesting thing. I showed him, because remember, his kind of in his head was, hey, I'm in my late 50s. I think I want to roll all my equity from my old house into the new house and then get this mortgage paid off.
Right.
And I said, okay, great. Maybe by taking a 15-year fix. That is fine. We will help you do that. However, consider that you're in your late 50s. You ain't getting it paid off by the time you actually retire.
Correct.
If you retire in your late 60s, that mortgage will still be out there with that larger 15-year fixed payment. Just a good rule of thumb, if you're looking at a 15-year versus a 30-year loan, the payment, even though the rate is lower on a 15-year, is still 35% higher. So my question for you is, if you retire and you're still in this house, do you want the big payment or the little payment? And I said, here's another thing you can do. We'll give you the 30-year. Yes, the interest rate's going to be 0.3% higher.
Right.
Knock yourself out while you're still working. If you want to pay it down, I'll show you the payment to make as a 15-year. But then when you retire, you can ease back to the 30-year. You would have thought I would have just given him the Rosetta Stone.
Yeah, exactly. Well, and that's people aren't thinking about this
Well,
every day
that's
like
not
you and I do.
That's right. He's a computer guy, not a mortgage guy. So this is about flexibility.
And why wouldn't you, Brian, this is something may help too, is some people may be thinking, well, I want to go with the 15-year now, and then 10 years from now when I'm ready to retire, I'll just refinance into a 30-year fixed. Why might not
that be good? Because we might be at the nadir, which is the low point of interest rates. And we don't know where interest rates are going to be 6-7 years from now.
Exactly.
And what if your income is such that you can't qualify?
Right. So, yeah, the ability to qualify, and we don't know what rates are going to be 10 years from now, much less, a year from now.
That's right.
As illustrated by the predictions we referred to earlier in the show.
Very bad predictions from the expert economists.
Right.
So, yeah, this way we can give you certainty. Yeah, is there a little bit extra interest rate? Yeah, but the flexibility, a lot of people value. They just don't realize that they value it. So that was one good suggestion. And then here's another interesting thing. In his particular case, because his credit isn't in the top-notch area, it's in the third best area, and because he's in a sales job where he gets a base salary. plus commission. He just started a couple months ago. I can't use his commission income anyway, right? Because he doesn't have a track record.
That's right. Underwriting guidelines will require, generally speaking, 2 years.
And we might be able to get away with 1.
Correct.
But in his case, doesn't matter. He's only been there 2 years. So I'm stuck using his base salary, which happens to be low enough that he still qualifies for the reduced lower income limits on Fannie Mae's fabulous Home Ready 30-year fixed rate loan.
Very nice.
Which also happens to reward or give better pricing. This is counterintuitive. He's better off putting 19.5% down than 20% down. And that is another mind blower for people.
Right. Until you put it side by side for them.
Which I just did here. You can't see it on my screen, but I gave him, hey, here's it. And I said 15% down. Oh, I don't want to pay PMI is the other objection.
Right.
You know what? Get over it because you're going to get better pricing. So here's the upshot. 15% down, and I was doing on a $250,000 home. If he puts 15% down, his payment's going to be $1,443, and he'll need $42,000 to buy the house.
Okay.
Down payment, closing costs, all that. If he puts 20% down, oh, by the way, and loan costs, $1,250.
Okay.
If he puts 20% down, now all of a sudden he's subject to a big penalty. That if he wanted to keep the rate the same at 3.99, now all of a sudden you have to pay $4,000 in closing costs. So $2,750 more. Light that money on fire. It's gone.
And that's because Fannie Mae is willing to pay a little bit more to service the loan with the protection of
the PMI.
The PMI.
That's right. It makes it safer for Fannie Mae.
Right.
That's the technical reason of why. But the bottom line is, and then this payment's only $100 more.
Okay.
So here's the other quick math. $15,000 difference in cash needed to buy between the 20% down versus 15. If he just took that $15,000, put it in a shoebox, he could take out the $100 payment difference every month for, are you ready? 150 payments.
You did not even use a calculator for that.
It's 12.5 years.
Right.
And then, by the way, the PMI is going to drop off after about 4 years, so that'll narrow the payment difference down to $60. So we're going to talk about that with him tomorrow. And then he's got that money, I'm like, maybe you could put that in an IRA because he would qualify right now at his reduced income for a Roth IRA. We'll leave that to the Spano and Tony Drake, but he qualifies to stick that in a Roth IRA, and then that can grow tax-free over the next how many years?
Right. Now, and were you showing him, Brian, a monthly mortgage insurance?
Monthly mortgage insurance,
versus a single premium.
Just because it would go away in 4.3 years.
Sure.
All right. When we come back, let's talk about condos, because you were saying you talked to somebody this last week who was buying a new construction condo, which is always a little more tricky than you might think.
Yes, condos.
Yep.
You had another interesting situation. Accessory dwellings.
Accessory dwelling units raising its ugly head again.
And then we can talk about millennial home buyers. Are they buying homes? Are they not?
Oh, my God, yeah. All right, all that and more when we come back. You're listening to the Accunet Mortgage and Realty Show on AM 620 WTMJ.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on WTMJ.
All right, we're back. I'm here with Jerry Sirkatich, Senior Vice President, Managing Owner of Accunet, and he's going to share a story in just a second about a condo buyer he talked to this week. Speaking of condo sales so far this year in the 5-county metropolitan area, according to the Multiple Listing Service, are down 6.9% on a count basis. How many? That's 188 fewer condos that have changed hands for the first 8 months. That would make it about 23 fewer condo sales per month. Listings are down 4.5%. That's 155 fewer listings. So that is a tighter market than the single-family detached market. And I think it's because of all of us baby boomers, Jerry. So what's the story on your buyer?
Well, since you're referencing condominiums here, it's important, I think, to share again, and we've talked about this before on the show, but when buying a condominium, we not only have to underwrite the income, employment, credit profile of the borrower, the borrower, but also then that condominium association.
What?
Right, and the health of that association. Is it solvent? Are they putting enough money away for reserves and so forth? But beyond that, the first cut is really, is this an established project or one that is either just newly built or still
recently
under construction
Yeah,
and
what was the
subject to
case
additional phasing? And in the case that I had here, this one happened to be, when I asked the question, which is always important right up front, you mentioned it was new construction. In this case, we were okay because all of the buildings, this gentleman is buying in the last building.
Okay, so he's at the tail end of this condo development, which is safer for him and for Fannie Mae.
Correct. Tail end of the development. Literally, he's buying in the last building that was constructed. And this was, I think it was 14 total buildings, all 2-unit buildings, so not a real large project.
Yeah. So 28 units, and he's in the last building. So all the rest of the buildings were built. What about any common area, any clubhouse or anything like that?
No, this one was simpler because it was a smaller project, so they didn't have the common areas, a clubhouse and pool and so forth.
Okay. But if you did,
all of that would need to be complete as well.
Okay. And then how many units have to be sold?
Well, it's a percentage. I mean, in this case, it was over 90%. What's the
sold and closed?
Sold and closed.
Okay.
Yeah.
So if 90% or more are sold and closed, you are in the good bucket of a existing condominium.
Right, and there are exceptions, but it's just important to know that if you're looking at condominiums and you come across a unit that you really like in one of these newer
because who wouldn't want a newer one? I mean,
right.
It's beautiful, right?
Right. And there are other alternatives to financing, too. What we're talking about is the fact that the conventional 30-year fixed rate that most people think of and want may not be available right away if you're buying in a condominium project that doesn't meet Fannie Mae's standards of warrantability.
I had one earlier this year where a retired couple, again, thinking about paying cash, but their financial advisor connected them with me. And we said, whoa, let's do a 15-year fixed again, right? Don't pay it all down at once and let your financial advisor keep that money invested. And then by putting 30% down, we have a portfolio bank who doesn't sell their 15-year fixed rate loans to Fannie or Freddie. And so then they were like, this is a slam dunk. We'd love to do it, blah, blah, blah. So a 15-year fix can be a solution. Also, an adjustable rate mortgage where the interest rate is only fixed for the first 5, 7, or 10 years can sometimes be a solution. Again, because those loans don't necessarily always get sold to Fannie Mae and Freddie Mac.
And most of these banks are not willing to hold a 30-year fixed rate on their balance sheet.
And then lastly, the other thing that can come into play when you're buying a condo of either stripe, either new or existing, is that down payment threshold, where we have to get nosier. And so on a primary residence, what's that down payment minimum where we have to do a full review?
5%. So if
less than 10.
Less than 10. So if you're investing a 5, correct, 8 or 9% would fall into that bucket as well.
For God's sakes, put the extra.
But once you get to a 10% down payment, you can avoid that full condo review, which does involve more of getting probing minutes of the last meeting, the condo budgets, and so forth.
Which, by the way, let the record show, if you're buying a condo, you should be looking at that stuff anyway. You should be looking at the budget and trying to assess, hey, have these people has this association been setting aside enough money to put the new roof on and the new windows and repave the parking lot? Because the natural human condition is to assume that they've been doing a fabulous job. But guess what, folks? Not every condo association is well run.
Correct.
And so if you're buying, even if you're paying cash, you should take a look at that stuff. I have a blog. If you Google Accunet condo or Accunet condominiums, you will find my blog post on the ins and outs of condo financing. All right. When we come back, we've got a cool article here that Jerry found from U.S. News and World Reports. The 7 upgrades that will attract first-time millennial homebuyers. We'll cover that when we come back. You're listening to the Accunet Mortgage and Realty Show on AM 620 WTMJ.
Helping you find a place to call home. This is the Accunet Mortgage and Realty Show with Brian Wickert on WTMJ.
Joined this morning by Jerry Circatich, our Senior Vice President and one of our managing owners. Thanks for doing the show today, Jerry.
Happy to. Always a great time. And,
fun times. We're just here to help people, do a better job at either managing their mortgages, do a better job, take advantage of the equity. I saw one article this week, or maybe it was last week, talking about how there's record equity now in people's homes, but we're not tapping it like we did in the last boom cycle of 2006 and 2007, which is fine.
Not yet.
Not yet. we're happy to help you consider that. It's not for everybody. You should do it judiciously. Generally, my rule of thumb on taking cash out is if you're going to extinguish debt or combine debt that you have no chance of chipping away at, as you mentioned earlier in the show, that's fine. Remodeling, certainly, because, Warren Buffett's old bromide is that you should match the term of the debt to the term of the asset that you're financing. So if you're doing remodel, that's going to last 30 years. Fine. Go ahead and take cash out and do that. Don't take cash out to buy a car. The car is not, and then finance it over, 30 or 15 years. Why? Because the car's not going to last that long. Right? All right, so that's one thing. But you found this cool article in the U.S. News and World Report by one Deanna Haas, and talking about the 7 home upgrades that will more than likely attract first-time millennial home buyers. And let's kind of debate these one at a time.
Well, and what kind of caught my interest, too, Brian, initially, the 7 upgrades are interesting, and we're going to get to those. But the first thing that caught my eye was that we hear a lot about how millennials are not forming, and not buying
horse
homes
hockey.
Exactly,
they are out in droves, folks.
Correct. So definitely a misconception. This article referenced a Realtor.com analysis published earlier in the year that millennials were actually accounting for more than 40% of all new home loans.
I would believe that.
Yeah.
I bet you if we looked at our data, that would be on purchase transactions true, because they're not going to be cash buyers. Some
Correct.
of your baby boomers are going to be cash buyers. All right, so item number 1 that I thought was interesting, smart home technology. Whole house connectivity, controlling the thermostat, sound, and lighting. Do you have that?
Alarm systems, all this stuff now. No, I do not.
But I wish I would.
Right. Oh, yeah.
Probably need a millennial to install it. Item number 2, this makes sense to me, gathering spaces. Spaces to gather, entertain, watch a game, so kind of open concept.
Right, and they like to have all their friends over. And one of the points also mentioned a video game.
Gaming center?
Maybe a gaming center, a gaming room or something, yeah.
All right, this next one is dumb.
Well, it's so simple, inexpensive.
USB chargers.
Yeah.
Really?
But I think when a millennial is walking through a home and they see USB chargers in the kitchen or in the
Is this like something you install in the socket?
Well, a lot of them are now as part of the outlet. Where you plug in an outlet, you can.
Okay,
it'll have a
so
USB.
like on the plane, Becky and I flew on Delta, and they had that kind of combination thing in the seat, which I thought was really cool for the AC or the USB.
It's becoming more expected, I think, in a lot of areas. I happened to golf yesterday. It was a little chilly, but a great day for golf. The golf cart had the USB.
All right. I retract I think that's stupid.
And the point is, it's a real simple item. But
you just got to change the outlet?
That catches the eye of especially of a millennial buyer.
Okay,
right.
All right. Number 4, you and I both thought this was good. A home office.
Oh, indeed. How many more people do we talk to or know? Or right here at Accunet headquarters, many more of our employees working remotely. It's great. It's becoming more commonplace, especially with younger professionals.
So maybe if you have a 3 or a 4-bedroom home, you convert or decorate one of those as a home office.
Right. Importantly, you have probably at least 3 bedrooms.
Yeah.
So that you've got 1 or 2 bedrooms used as they're intended. Maybe you convert one to stage as a home office if it's not being used that way.
All right, getting down to the last minute of the show here. Energy saving appliances, whatever. Okay, neutral colors. I like that one.
Well, and that's been tried and true for baby boomers.
Everybody.
Yeah,
but don't make them work for it. Don't make them have to imagine grandma's purple bedroom. And then garage technology. What does that mean?
Well, some of these newer door opener technology, where again you're kind of that connectivity we talked about, the whole house connectivity. You can from your phone you can close your garage door,
or if you don't remember if you closed it or not.
Or you get an alert. You're at the office. You get an alert on your phone says, "Hey, your garage door's open." You can close it from there. That kind of thing.
All right, so there you go. We're doing our little bit for sellers. Usually we focus on the buyers on the show. So the bottom line takeaway, folks, rates are still great. Great opportunity to reconfigure your balance sheet restructuring. And there's still a lot of people who got loans last year at 4.875 that could benefit from refinancing. 30-year fixed rates are in the high 3s right now. And if you are out there shopping, you or somebody be sure to tell them about Accunet's rock-solid guaranteed pre-approval. You need it because this fall is still a very competitive home shopping market. We'll be back here next week, same time, same channel. You've been listening to the Accunet Mortgage and Realty Show on AM 620 WTMJ.
The proceeding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors, and not WTMJ Radio or Good Karma Brands Milwaukee, LLC.